right.
I like that
All
guitar.
right. Yeah. All right, let's see if I can do it right this time. I'm going to fade it out. See if it works. All
You have a
right.
new occupation as a DJ if you can fade it out like that.
We just got it. We figured it out finally on the,
There
what
you
is this,
go.
our sixth episode? We
Radio's
finally
dying, but you've got a second job in radio if you need it.
well, I always been told that I have a face for radio. So that would definitely be a good career choice for me if this
It's the
doesn't work out.
compliment that everybody wants, man.
That's right. But welcome back, everyone, to the I Love Annuities podcast. This is Jeremiah Konger, along with my handy dandy sidekick, Zachary Van Es, and we are the Annuity Dudes. And today we're going to be discussing a huge topic that we believe is critical to righting the wrongs of our industry. So if this is the first time you're tuning in, we are part of annuityassociation.com. And we are an independent annuity advisory firm specializing in bringing more transparency, education, and ultimately helping consumers lift their annuity IQ to make more informed and confident decisions. And part of our mission is exploiting the wrongs of our industry. Unfortunately, within our industry, there are a lot of shady sales tactics. There are a lot of smoke and mirrors. There are a lot of just wrongdoings ultimately in our industry. And sometimes it's by accident. It's not intentional. It's just because of the complexity of the subject matter and some other things that we'll be covering. But the episodes is essential to helping us meet our mission of righting the wrongs of our industry. And that's to be fully transparent, to really bring light and shed light on some of the things that we see and hear that are wrong by the advisors and agents representing annuities or misrepresenting them for that matter. And this episode is titled The Massive Mistake That 99% of Annuity Buyers Make. So we're going to go right into it without further ado. So did you know, Zach, that a staggering 70% of annuity buyers regret their decision within the first 5 years? That's right. According to industry surveys, most people who purchase annuities later realize they made a massive mistake. But why does this happen? And more importantly, how can you avoid it? Does that necessarily mean that annuities are bad? No, I wholeheartedly believe that they are good. Not all annuities are good. And majority of the time, annuities are misrepresented and misapplied or inappropriately applied to someone's overall plan. But we are going to discuss the key topics of what those mistakes are and how people can avoid them.
Yeah, and one of the key things that we focus on is finding the key fit, the fit for that person's need and their criteria. To your point, it's not a one size fits all. And annuities can be an amazing tool. Whether it's guaranteed retirement income, safe market growth. However, unfortunately, most people buy the wrong annuity for their needs, especially if it's being approached as a one size fits all. But today, what we're going to do, we're going to uncover the number one mistake that 99% of annuity buyers make and how to make sure you're not one of them.
Yeah, so let's set the stage here. Annuities are one of the most popular retirement investments in America. Why? Because they provide guaranteed income. It's as simple as that. It's a contractual guarantee of income in retirement. In addition, they'll also provide contractual guarantees around protection from market downturns, which ultimately leads to peace of mind for retirees in that most critical phase of their life.
Yeah, and really what we see is the big problem is that annuities are often sold, not bought. And that's one thing that I've heard you say before, Jeremiah, and I've mentioned that before to some clients who have been in that position and come to us with a problem that we need to find a solution for. And really what I mean by that is most people end up with an annuity that was pitched by a salesperson rather than one that was chosen based on their specific needs.
Yeah, and I think it's all about understanding how and why that occurs. We're not here to hide anything from anybody. Again, transparency is our founding pillar. That's where our firm started, was to be more transparent and figure out better ways to introduce people that can benefit from annuities to the wide world marketplace of those annuity products. And when we talk about annuities being pitched by salespeople, there are a few reasons of how that can occur or why that occurs. Um, I think the main thing is really understanding that there is, for the most part, a low barrier to entry for people to get a license to represent or offer annuities. I think that's, in my opinion, one of the biggest areas that needs to have improvement, is making it a bit more challenging to get a license to, sell annuities or offer them to people. But oftentimes the reason that these annuities are pitched are for the wrong reasons. And so let's be real that most people don't fully understand what they're buying, and they hear about these big bonuses, lifetime income guarantees, and all sorts of bells and whistles, but they don't really dig into the fine print, and they don't have a way to compare and contrast the different features and benefits from multiple annuities.
Yeah, and that right there is where the trouble starts. Yeah. So what we're going to do today, we're going to break down all of this, how it happens, why these events occur, and most importantly, making sure it doesn't happen to you.
So, what is the biggest mistake that 99% of annuity buyers make? It's simple. Here it is. They buy an annuity based on marketing hype rather than actually doing financial analysis to see how the annuity can serve their objectives now and into the future.
Yeah, I think you, both of us, have run into this before, where we've met with clients who have been put in that position, um, and really we're backpedaling and trying to find the best fit moving forward, to fit their intended need of what they came up with to begin with. I don't know if you can speak to that a little bit in your experience.
Yeah, I mean, we hear it all the time. One of the things that I try to make sure that I uncover and put on the table right out of the gate in our first meeting with a prospective client is, have you been talking to other advisors or agents? And if so, what is it that, you're liking about the things that you're learning and working with them? And what are some things maybe you don't like or have some questions about? And I try to dig even deeper into what, specific products or features and benefits they're being pitched, to determine whether or not they're, who they're working with is being honest. That's really what matters most, is honesty. Again, I keep talking about transparency. And ultimately, our goal is to foster trust, and that can only be done with transparency and education. And so, as an example, I was working with a gentleman the other day, pretty well-to-do guy. He was an engineer, did a really good job saving for retirement. He's amassed a few $1 million in retirement accounts, and he's looking at securing guaranteed lifetime income for him and his wife. And he's actually looking to do about $1 million in income annuities. And of course, he came to us after working with somebody, which is common, and we encourage everybody to be working with multiple advisors on these annuities, because it is important for you to get information from different sources to validate what's right and wrong, or what have you. And so, of course, he's doing just that. And I ended up being the second advisor that he's come to. And the first group that he's working with have pitched him a particular product, very common on the market, very popular brand name. I'm not going to disclose who that is for certain purposes there, but it's a very common product, very common brand name. And it's a brand that, they always say they're on your side. So if you can put that all together, I'm sure you can figure out who that is. And anyways, he's being pitched on this product, which is offering him a fairly competitive guaranteed income based on his needs. He's planning to defer the income for 8 years. And when he told me that was the product he was considering, I first asked him why. And he said, well, it's an A+ rated company. It's a brand and name that I know and trust. And, this group that I'm working with, they're pitching me on this product and how it's the best thing since sliced bread because of a particular feature where the income can potentially increase over time. So it starts out at a fairly competitive amount, but it can increase over time. And that's kind of its claim to fame. And so when we went through our analysis and understanding what his goals were and what his objectives were from an income planning perspective, we uncovered probably 5 or 6 annuities that offered a contractually guaranteed higher income amount than this other annuity that he was being pitched. And so I asked him, I said, did they show you any other products at all besides this one? And he said, no. And I said, well, that's kind of interesting. I said, that's common though. We hear that all the time. So kudos to you for doing your due diligence to work with somebody that is independent and can have access to all of these annuity products on the market to really take you through an engaging and interactive process to help you compare every annuity available on the independent annuity marketplace side by side. And then even more, unveil the curtain, unpeel the onion there and look at everything for what it is and do so with facts and contractual guarantees. And so by uncovering the 5 or 6 annuities that offered contractually higher guaranteed income, it really brought some light to his evaluation of who he was working with prior to coming to us at Annuity Association. And it really made him scratch his head of why was he not presented these other options? And that's really one of the wrongs of our industry that we're really trying to make right, is everybody should be able to have an easy way to uncover every annuity that's out there and available to them, and then help them make an easy, transparent, comparative process of analysis so that they can truly get the most value and the best bang for their buck, in other words. And so, with that being said, I know I'm getting a little long-winded here, but I'm passionate about this. It's so important that people understand that, there aren't very many places or ways to compare all of these products. And that's something that we're striving to change. But long story short, with that client, he was still pitched on this whole increasing income perspective of this particular product and that it could increase over time. And so I said, well, have you looked at those index options that are available in that product to really determine if they perform? And he says, well, yeah, they showed me this illustration that showed a back-tested return of a 12-year period. Well, let's face it, a lot of these indexes in this industry were created within the last handful of years. A lot of the innovation in our space has happened within the last 10 years. On the indexing, a lot of the innovations come within the last 3 to 5 years. And with that being said, in that product, the indexes that he was being illustrated were created back in 2021 and 2022. So not a lot of proven track record, but they have incredible back-tested performance because those indexes are created with hindsight. When these investment banks create these indexes, they're able to use hindsight as a way to tell the algorithmic-based index how to move and shift and rebalance throughout those periods of volatility. So of course it's going to look really good. And then when you combine that with a very strong market the last 12 years, it's going to look incredible. But what we believe is a better way to evaluate the potential if an annuity can increase the income or not is to look at real data, look at real track record, not back tested. But when the index went live, can it and will it have the potential to perform? And what we found, I did that analysis with them. I pulled the 5 or 6 indexes offered in that product. We pulled the report, which we're going to show you an example of later on in the show. I'm going to share my screen. We'll pull up the index tracker that we use. We'll look at real performance and, come to find out. And, it wasn't a surprise to me. I already knew this, but to him, it was a shocker. Those indexes were abysmal in their performance the last, few years when they went live. When, if you look at the rest of the market, they've been all-time highs. So it doesn't make sense there why they don't perform. But either way, I believe we saved him from a mistake. I'm still actively working with him. I have a 3rd meeting with him next week. and we're going to see what we can do. But the income annuity that I showed him just out of the gate, highest contractually guaranteed income was about $9,000 more a year. $9,000 more a year. It's not chump change. So with that being said, I know I got off topic there.
No, that's a drop the mic moment there. You're good. But no, that's why we do this, right? So it's exposing what realities we can offer and the transparency and knowing that we know, and I'm confident, you're confident, everybody in the association is confident in our ability because we know the information that we can pull, the education that we've received, and the continued education that we have that we can pass on to our clients and anybody who's wanting to meet with us and just talk more about it. And really what you've shown here is instead of choosing an annuity that fit their retirement plan, he in a way got approached that was illustrative, right? So it was more so, how do these illustrations show? Are they realistic or not? And in some cases, it's a pushy sales tactic. And that's what we're not about in our world.
Yeah, and it's not even the client's fault if they make these mistakes, and that's one thing that I want to make sure we're
Yeah.
covering is it's not their fault. They're making these decisions based on the best information they have at that time. And sometimes these people are too trusting in who they're working with, and sometimes these relationships that they're working on this annuity transaction with, those relationships have been long term. I had another guy, I'm not going to get long-winded in that one, but I had another guy, his financial advisor has been with like his advisor for 20 years. And then when it came to the annuity conversation, because now this gentleman's entering retirement, the annuity that the advisor of 20 years, who's a friend of his, who's been literally like at his kids' birthday parties and things, showed him this bogus product that was just full of BS with lofty bonuses and, you know, unrealistic return expectations and other things. And so he was lured into that. But luckily, um, another intelligent person, he's another intelligent gentleman that saw the product for what it was, scratched his head when he's like, this sounds too good to be true. And then he approached me and I'm working with him too to help him avoid the mistake. And guess what? After my first meeting with him, I don't even know if I should share this, but he called me later that day. It was a morning meeting. He called me in the afternoon. He's like, Jeremiah, he's like, I did it. And I'm like, what? And he said, I called, the advisor. I don't want to say his name here, but he's like, I called my advisor and I severed the relationship. He's like, we can still be friends, but I don't trust him anymore. And I'm not, with my finances. I think he's good at what he does with investment management, and he's done an okay job getting me to this point. But he showed me that he's not a retirement planner. And those are two freaking entirely different things.
Yep.
An investment manager or an investment advisor, as they call it, is not a retirement planner. There are two different subject matter expertise categories. Yep. It's no different than, the medical field. I use this analogy all the time. If you have something wrong with your heart, you're not going to go to a dentist because he's still a doctor, right? He doesn't specialize in cardiology, right? So no different. An investment advisor is not also an expert in annuities, and you should have experts in each of those categories.
Yeah, and oftentimes we will find that an investment advisor will have access to some annuity products on the market. Commonly, what we see is that it's a limited tool belt. So there's not the vast options that we can choose from, or not only that, but the approach that we take to it. But oftentimes we're finding that there's a few annuity products. They'll position those 1 to 10 products if they've got them. They're not going to compare all the options on the marketplace. And typically, I don't think it's ill-intended to the point that you had made, is that it's just what they have on their tool belt, what they have access to.
Yeah, there was a good survey done not too long ago by one of the industry leaders in research. This industry, or this firm rather, researches the annuity industry and actually collects data on, which carriers sold the most products, which carrier products specifically were sold the most, um, so on and so forth. So they track the volume in our industry quarter to quarter and annually. And one of the surveys they conducted of the annuity advisor industry was the question was, how many annuities do you sell? And what came back was like mind blowing. The average annuity advisor only sells three products, three, three only. So it can be multiple companies, but it's generally three. So think of it like, you know, for a bad example here, but it's what comes to mind. Like you go to McDonald's and they have a limited menu these days. Like there's not a crap ton of options like there used to be. It's to simplify the approach to the sales. And most advisors only have three in their tool belt. So if that's the case, which is another wrong of our industry is that advisors are not truly acting in the best interest of the client if they only represent three different products. But one thing I can tell you is I don't blame the advisor. I blame our industry. I blame the antiquatedness of our industry. The average advisor in our industry is 54 years old. No offense, but they didn't grow up with technology. So they're, not as capable of leveraging technology to solve problems as we are today, at least with our generation. In addition to that, these insurance companies have gotten too comfortable. They've gotten too comfortable in the way that they do business. And as long as those premiums keep coming in, they're happy. And they're not moving and adapting and changing quickly enough to an ever-changing world, especially when it comes to tech. Technologies is growing at such a rapid rate, but these insurance companies are still acting like it's 1970. It's unbelievable. I mean, I remember just like 4 years ago, we're in 2025, so like right around COVID, most companies, not all of them even had electronic application. You still had to submit a paper application, and then guess what? You had to fax it in, which is even crazier, right? Who owns a fax machine today?
That's funny you bring that up. I was working with a doctor recently, and he was filling out a form for a carrier, and he said, "Hey, can I go ahead and fax this over to you?" I said, "Mr. So-and-so," I said, "I do not have a fax." I said, "I'm so sorry." But yeah, certain industries.
We do have a company fax if you ever need to use it, but
yeah, and certain industries, they're like that. And I think medical field is one of those as well, where getting into that a little maybe too far, but some industries are just a little bit antiquated in their approach. And yeah, I agree with you. Our industry needs to come around more on that.
yeah, so you add into the antiquatedness of our industry, you add in these annuity salespeople that are not fully invested in the industry. They're just trying to make ends meet. And so they're really being more motivated by making a sale versus actually helping someone in their financial future. That's wrong. And I hate to hear that actually happens still, but it is what it is. It does happen. And because of these reasons and a few more that we're going to cover in just a moment, that's why so many annuity buyers end up with something that doesn't truly serve their needs. And they aren't shopping for the best annuity. They're actually being sold the most profitable annuity sometimes in that case for the salesperson that's writing it for them. And that's something that we're very, very passionate about changing.
Yeah. Yeah. And that's one element. I think what we wanted to do today was cover 5 key ways that this mistake happens, where we had mentioned that the subject line of this podcast is the way that 99% of annuities are bought wrongly, or the mistake that 99% of annuity buyers make. So let's jump into that. Number one would just be purely lack of knowledge, like we had mentioned before, where most people don't fully understand the annuities before buying one. So as with any industry, there's industry jargon and complexities. If somebody's in the medical field, use that example again, I'm just not going to understand some of that information. So unless somebody's sitting down explaining that specific utility, its jargon, and what it's capable of doing, I'm not going to fully understand it.
Yeah, and that's another thing that I blame on the industry, right? Like every
Mm-hmm.
carrier has their own nomenclature or terminology or jargon to define a specific feature or benefit that is a universal feature or benefit in just about every other product out there in the annuity world. But yet one company calls it something and another company calls it another. That's confusing. I think there needs to be model regulation over the industry that blankets the terms and the jargon that can be used to just make it more streamlined across the product inventory, so it can help not only the consumer understand it, but it can help the advisor or the new annuity rep, right? That it can help them learn it quicker so that they can be more efficient and more effective in their meetings.
Yeah. Yeah, without a doubt. I mean, one that comes to mind, I know you've heard this before, is a fixed annuity or a fixed rate annuity compared to a multi-year guaranteed annuity, or its acronym. Again, we all fall into the weeds of using acronyms, MIGA. So it becomes a little bit more complex when we're using those acronyms for somebody who's outside of this industry, and it's easy for us to use it on a daily basis. Meanwhile, we might be meeting with a client for the first time who's never talked about annuities. So dropping certain jargon can be confusing. And that lack of knowledge is what we're here to fill when we're meeting with our clients, providing that transparency.
Yeah, and that's important, right? Is simplifying the understanding or lessening the learning curve. Like
Yeah.
we won't use big, jargon or complex terminologies in our meetings. We're going to break it down and really reverse engineer the process in terms of what are your needs, what are your objectives and goals. If it's income, we're going to talk income annuities. If it's growth, we're going to talk growth annuities, and we're going to break it down in easy to understand terms so that the client can relate and that they can make an effective and an educated decision. That's ultimately our goal, is not to sell you an annuity. It's to help you understand the annuities, which ones can help you, meet your objectives, and then take you to a point where you can now assess the marketplace because you have a good understanding of how things work and what's available. And then you can go to select and pick and choose your own products and even work with us to do the side by side comparison. Full transparency. Yes, we make our living by placing annuity business in force. So we hope that through that process, we can build trust and earn your business. But ultimately, it's to help you make your own decision. And that's what we're all about.
Yeah. Yeah. And I think what shows in our relationships with our clients that are ongoing beyond the point of sale, but also with our Better Business page and the reviews that we have, it's proven that we're not a high pressure sales tactic, right? This is education first, which brings us to the next point of how we get here, and that's pressure from salespeople. Why these mistakes are happening is lack of knowledge, pressure from salespeople, and that high pressure sales tactic will often lead buyers to making a rush decision. And the number of conversations that I've had where somebody feels they've made a mistake, and that mistake was made in one meeting with that salesperson, um, that's hard to hear.
Yeah. And we hear them all too often. And it's just painstakingly true that there are bad people out there that are misrepresenting the products and using these shady sales tactics to make people buy or rush into these decisions. I remember another story of a situation where I was working with a client. They were working with another advisor again, and it's common. We want that. We want to be up against competition. It makes us sharper. But they were working with someone else, and then out of nowhere, that client called me, and they were like, "Hey, Jeremiah, I just heard from the other advisor I'm working with, and they told me that I need to go ahead and sign the application now because there's a deadline." And I said, "Well, what deadline?" And they said, "Well, they're saying that the income quote they gave me is going to expire, or the rate is changing." And that was what it was. It was a rate change, and it was on an FIA. It wasn't a SPIA. SPIAs do have rate locks where they expire on the quote, but this was an FIA. And I said, well, I'm not familiar with that rate change. Let me do some digging. And we have multiple databases that we can go to when rate changes are occurring. And there wasn't one. I even called the carrier directly, and I called our point of contact there. When you do the amount of volume that we do, we have, the bat phone where we can pick up and call someone directly. And I called that carrier. I was like, hey, what's going on? I'm, being told that there's a rate change happening. They said there wasn't. There wasn't a rate change on the horizon, that there wasn't any announcement to them, and there wasn't one to be concerned about. So I called the lady back and I told her, I was like, look, there's no rate change on that product. I don't know what they're talking about. Whatever you do, don't sign it. You don't have to. And you should never be forced into making a decision before you're ready. I don't care if there's a rate change or not. Now, one thing we will advise people on that we're working with is if there is a rate change, we're going to show you in writing that there is, so that you know with full transparency, again, going back to that word, transparency, that there is a rate change. And then on that rate change document, which if someone's ever coming to you saying, hey, you need to sign for this rate change to avoid the rate change, have them show you the document, because there is a document. And the document has the rules of when and when the date has to be done, when the application has to be in by and received in order to receive the higher rate. Ask them for that. But that's what we'll show you if that ever occurs, so that we're being forthright and honest. And it's just crazy out there. And then, if you really want to talk about some other, high pressure sales tactics, and where I believe is one of the things that irks me in this industry, and I know I'm going to get a lot of hate out there from the advisor world, but I don't really care. I think it's right to do what's right by the client, and having these workshops and dinner seminars and kind of doing a smoke and mirrors pitch fest where you're saying that the topic of discussion is going to be about Social Security planning and how to optimize Social Security, but then at the end of that seminar or workshop, or maybe even you book a meeting, you pitch an annuity. It's a pitch fest for an annuity sale. And what oftentimes happens, they're not doing the holistic approach of the annuity planning. They're pitching one product. And there's a big carrier out there that makes their living on paying for advisors' workshops and dinner seminars to get people to those events. And then at the end, it's a big pitch fest on one, flagship product from a carrier. And it's wrong, man. I'm going to put it out there. I don't care who hates us for it. That's what we're here to do, is bring transparency to the wrongs of our industry. And that's one of the things that irks me. I go to these conferences, these financial services conferences, and then all of these big guys that are doing all this volume get up on the stage and they talk about their best practices. And the best practice half the time is a smoke and mirrors pony show, or whatever they call it. It's ridiculous, and it makes me sick. And I don't like it. And I think that there's a better way to do it. And that's what we're doing. Yeah. That's been the driver since day one, that we're going to do it right. We're going to do it the right way. We're not going to be shady about it. Annuities are good products. Why are you scared to tell people what you're there to sell them? We're not. Yeah. The name of our company is Annuity Association. Okay. When you talk to us, you're going to be talking about annuities, not Social Security, optimization.
It becomes frustrating, but at the same time, it does become laughable, or it's just like that. We don't need to gloss over what the purpose is that we're here for. It becomes a little frustrating. And I think to the point that you make about the rate changes that happen, that, if you're looking at a specific annuity, you should be informed if a rate change is happening. It shouldn't turn into a high pressure sales tactic to get you to sign your name on the dotted line. And that's the approach that we will take, is we'll always let you know, hey, X, Y, and Z are happening, just so you know. Leave it there for you to chew on, and how it may affect you or may not affect you. But at the end of the day, that's not the reason to get a sale.
No. And there's actually a better option too. And that is, look, if the client is getting to a point where they're like, this is a good product. This is the one that I'm kind of leaning towards, and they do want to get that higher rate. It's simple. They can put in the application and sign off on it, but it doesn't mean that they have to fulfill it entirely with the funding aspect.
Right.
So to lock in the rate, and with most carriers or annuity providers, if you put in the signed application, you have a window of time of when it needs to be funded by. But as long as the application's in and the funds are in at that deadline, which is usually about 60 days after the application's been signed, and we can request extensions in most cases, especially our firm, since we do a lot of volume with a lot of carriers, we have relationships there. And we say, hey, look, we got a scenario where someone's funding needs to be pushed back a little bit. We can get those authorizations just about every time. Point being here is, if you want the higher rate, but you still don't want to feel rushed, you can still put the app in, secure the rate, knowing that you still have a window of time to fund it. And guess what? If you decide that that annuity isn't the right one for you, or we discover another product that's better after the further discovery, we can just cancel the application. You're not tied and bound to it and required to fund it. And that's important to note. You can lock the rate in, put the app in, but you don't have to fulfill it, and we can just cancel it. It's not a big deal.
That's right. That's right. So to recap what we've covered so far on why these mistakes happen: lack of knowledge, pressure from salespeople. The next would be misleading marketing, which you you really hit on there already, just in the approach that sometimes how annuities are positioned. But in addition to that, another thing that you and I have both heard before is a big bonus. Maybe that hits the billboard a little bit more often than it should. And also, we'll often see higher illustrated returns, which jokingly we came up with another term for that. But big bonuses, higher illustrated returns, and these are often used to bait somebody into an annuity and seem better than it can be.
Yeah, the big bonuses, that's just something that I've, since day one, since we've been putting content out, this is 5 years ago now.
Mm-hmm.
One of the biggest things and messages that I've been trying to bring and shed light to was that don't get caught up in the bonuses. The bonuses are hype. It's all marketing fluff. It's all used so that they can print it on a pretty shiny brochure, or an agent can come to you and say, hey, look, Mr. or Mrs. Jones, if you buy this annuity, we're going to give you a 20% bonus. It's all crap. And the old adage, if it's too good to be true, it usually is. And that's what my mom taught me. So when I came into this industry and I started trying to figure out how can I, do the right thing by the client, make the best recommendations that I can. Well, first I had to kind of, explore all of the things out there, and then look into these bonuses and these other features and terms and see, what is it? Are they real, or are they real BS? And I hate to say it, but about 99% of the time it's real BS. And we're a no BS type of firm. We're going to show you that. We can prove it to you in in a moment. We're going to share our screen here, and I'm going to show you the differences between the products that have bonuses and don't, and show you why the bonus is in general a bad deal. There's only one product that comes to mind on the market where the bonus can potentially benefit somebody and make sense, but that's only if it's competing with another product that's not in its own product suite. In other words, there's one carrier that has a bonus product, which is a good product. It's better than a majority of the other products out there with or without bonuses. But even that one carrier has its own product that doesn't have a bonus that's actually better, because it offers higher growth potential through the crediting rates.
Yeah.
So we'll show you that here in just a moment. But big bonuses are a big no-no. So if anybody's leading the conversation around a bonus, you can go to annuityassociation.com and right there, book your meeting to speak with a real expert that's going to, unveil the curtain and show you everything you need to know, and how to assess the marketplace and compare. If someone's pitching you a bonus product, it's our job to show you how it doesn't benefit you, and we will. So that's my guarantee on this show.
if somebody's starting that conversation with a bonus, the alarm should be going off. The red light should be flashing. That's not a good sign. And that's when you go back to the pressure from a salesperson. If somebody's leading with that, it's not well intentioned.
Yeah, and there's only 100 pennies in a dollar, and these
Right.
insurance companies are not here to give out free money. Let's be honest. There's no free lunch, and the bonuses, you have to see through them. I can show you how to do that. It's very simple. It's just a simple comparison side by side, and we'll show you that here in just a moment. But the other thing too is the agents are selling by illustration, and we actually came up with a term. Instead of selling by illustration, it's really ultimately selling by illusion. What happens is these illustrations that are condu- that are provided by the carrier most times are including these index strategies that are fairly new and weren't around in that back tested period, but they were created with hindsight in mind so that the index can look good if it were to be an actual real live index during that time frame, because they knew exactly what happened with the markets, all the different asset classes, and they can tell this index how to respond in those scenarios. Now, I'm not saying here that these insurance companies have, intentionally put these index strategies together to provide an illusion. What I am telling you though is that when you look at the last 12 years or 10 years, and it's been one of the most historic bull runs in history, everything did good during that time.
Yep.
But should we expect it to just perform that way out into the future infinitely? No, that's hogwash and that's ridiculous. So what I urged everyone to do, and it's what I did when I got into this industry, again, I saw it for what it was. These big bonuses, these highly unrealistic back tested returns. And I'm like, how in the world can this happen? Like, how did this index do that number? And so I started exploring it and researching it, and I found that, hey, they were created with hindsight in mind. Now I will tell you, there are seasoned indexes out there, ones that have been around for a long time, that you can use in these products, and they're great. Also, I will tell you that there are newer hybrid, if you will, indexes that use algorithms to rebalance and shift away from volatility. There are good ones. But what I can also tell you that there are bad ones, just like anything else. So don't take this, as a bashing of our industry. I make a living off of annuities and representing them the right way. Zach does as well. And our entire firm, which we have about, I don't know, at the time of this recording, about a dozen advisors that work with us. We all make a living, but we do it the right way. And we want to have positive conversations every year that we meet with our clients during their review process so that we can have a great conversation and discussion. And in order for us to do that, we have to research the marketplace. We have to discard the BS. That's another word I keep going back to, but it's a real word here, BS. We have to discard the BS, move that out of the way. We got to be able to sniff it out when we're working with prospective clients, when they're working with these agents that sell by illustration only. We got to sniff that out and do a good job with it. And then we got to help you understand how we came to our recommendation. And we do that with factual data that we're going to put right in front of your face so that you can compare the product that we're looking at and the product that the agent's selling by back tested illustration. And the way we do that is real performance. I'll show you exactly what the index did yesterday. I'll show you what it did last year. I'm not going to show you just 12 years ago and what it did for a 12-year period that it wasn't even real. I'm going to show you real data, and that's the point. So,
yeah, and ultimately it's putting our name on it too. So the way that we conduct our business is so that we have these annual meetings with our clients, reviewing the index performance, so that if we're in a 1-year period where that index will reset the following year, the expectations have been set. The client knows what's coming with this product, and there's no surprises, right? So our relationship lives beyond the point of sale. and we continue that relationship with confidence, knowing that we've done the right thing. Not only that, but provided the right expectations. So
Absolutely.
Moving on from that, we've touched on 3 of our 5. We're almost there. So why these mistakes happened: lack of knowledge, pressure from salespeople, misleading marketing is what we just covered. Next would be captive agents, which we had touched on briefly. So many agents are restricted to what they can offer. I had mentioned that when we were speaking of investment advisors. Oftentimes we'll see that there. So the question becomes, are they truly looking at all the available options, and are they truly looking out for your best interest? Now, again, on their tool belt of what they have access to, they may be looking out for your best interest. I don't doubt that. But having a larger option or a larger pool of options provides a lot more value in this case.
Yeah, and I think that it's really important to unpack, like, why does this happen, or how has this happened where there's like this captive agent sales force?
Maybe we define it too, and what that is.
Yeah, so a captive agent is someone that only represents one company, one insurance company, or one insurance marketing organization. And with that relationship, they can only offer the products that are part of that captive agency or that captive environment. So, for example, some of the bigger names out there of captive agents, they're Mass Mutual. Like if they work for Mass Mutual, they're a captive agent. They can only offer Mass Mutual products. Nationwide has their own captive agent side. Allianz has their captive agent side. Um, Northwestern Mutual, that's a big one. Man, those guys are sipping the Kool-Aid. I tell you what, Northwestern Mutual, those guys are hardcore, very good at what they do on the investment management side, not so good on the annuity side. Do better. There's a handful of other ones out there, but captive agents can only offer the products that are available to that specific carrier. Whereas an independent agent, which is what we are here at Annuity Association, we have no allegiance to any carrier. We have no allegiance to any product. Shoot, as a matter of fact, we don't even have an allegiance to any IMO, which is if you're not familiar with our organization, when you're an advisor, in order to offer products, you have to have a relationship with an IMO. And the IMO is kind of the middleman between the advisor and the carrier or the annuity provider. Most carriers don't allow direct contracts. So a firm like ours, even though that we do a good amount of volume, we can't just go to Nationwide and be like, hey, we just want to, sign up directly with you. We have to go through their channel, which is their distribution channel, which is called an IMO. So with that being said, because we're an independent advisory firm, we're not just captive or not captive, but we're not even just, relying on one IMO. We have relationships with, I don't know, it's probably 8 or 9 different IMOs now. And the reason for that is, and it's just a part of the crap in our industry. And I hate to bash it, but it sounds like I am, and I am, because there's a lot of wrong crap in this industry.
Yeah.
But there's like exclusive relationships in the IMO world where a carrier will say, hey, we're going to make this product, but we're going to make it exclusive just to you, and no other IMO can offer it. So if you're working with an advisor that's under an IMO that doesn't have that exclusive product relationship with that carrier, you're never going to be shown that product. And so in order for us to truly be independent, we have struck up relationships with every major IMO out there so that if there's an exclusive offer, we have access to it and we can offer it. And so then we can do the right thing by you. And that's ultimately acting in your best interest.
Yeah. Yeah. And we've seen that firsthand, and several times where we've pulled different information from one IMO, compared it to another. And again, it's just, we've got to vet through the information as we receive it, and then interpret it to the client's best interest. And that's what we're doing.
Yeah. So that's a key there. And so if you're working with somebody, ask them, are you an independent agent? And make them prove it to you. Most of the time they can't, but it's important for you to have that independent agent representing you, because then they can show you the entire marketplace.
Yeah, it would almost put in here as this top 5 list that we had mentioned as to why these mistakes happen is not working with an independent agent. I hate to put it that way, but I think that's crucial in this scenario.
For sure.
Moving on to our final point. So we've touched on lack of knowledge, the reasons why these mistakes happen: lack of knowledge, pressure from salespeople, misleading marketing, captive agents, or not working with an independent agent. And lastly, is that there was really no efficient way to compare products until now. Um, there really hasn't been any way to any easy way for consumers to compare all the annuities side by side in an unbiased manner. And that's really, again, where we come into play, what Jeremiah had created with the company, and everybody in our association, what our mission is.
Yeah, and that was the biggest pain point for me, that when I started as a young advisor in this industry, it was hard as hell for me to figure out how to compare all the products that were out there. And when I found out, so just a quick story, I worked for a smaller insurance marketing organization, and they weren't really set up for retirement planning and annuities and income planning and those things. They're more of a life insurance based insurance marketing organization, but they did have some annuity products. And when I started to learn about annuities, I saw the benefits and features and how they could be a very important, powerful tool for many people in retirement. And I will never forget, I got my first appointment for someone to talk about annuities. And, I sat down with them. This is back in the day when we used to go to their homes, actually. And I sat down with them, and they were a prime candidate for an annuity. They were very risk averse. They had recently retired. They had a decent amount of money saved, and they didn't want to risk it in the markets. And they were just sitting in back then it was a money market account, and it was literally earning like a 1% interest. This is when interest rates are real low. And I said to them, I said, well, what if you could get into something that would give you a guarantee of principal protection, but give you a bit more upside than what you're getting? Would that, make sense to you? And of course they did say that it would. So then I went back to my manager at the time and said, hey, his name was Brad. I said, hey, I've got this client here that is a great, an annuity would be a great fit for them. Can you help me figure out which one is going to be the right one for them? And he says, I don't know, man. He's like, we don't have a way to compare it. Just go through the brochures, figure out what sounds good, and then show them one or two of those. And to me, I'm thinking, I'm sitting there, I'm like, dude, this is their retirement. At that time, that small company only had maybe a dozen annuity products to offer. And so I had to compare. And so what I did is I built this Excel spreadsheet, and I created the columns for the features and shit, excuse my language, and features and benefits. And I went and, created the spreadsheet. And then I was like, all right, I found the one that's the right one out of the 12. But then I started exploring, and I found out that there's hundreds of these products out there, not just 12. And so I went back to Brad and I said, here's what I came up with, man, but there's hundreds of these products. Why don't we offer them? And he's like, that's not what we do. We're not set up for that. Nobody's really set up for that. We have the 12 that we felt were a decent offering, and those are the ones we can offer. So go back and offer that product, whatever product you came up with, to them. And I remember driving to that client's house, man, and I was like, this just doesn't seem right. I can't do this. And long story short, that was the catalyst
Light
to
bulb moment.
annuity. Yeah, that was the catalyst to Annuity Association. Here I am, a fairly new advisor. Very, I'm not going to toot my own horn, but I'm fairly intelligent. I know how to make good decisions in most cases, and how to analyze data. And then I saw, I'm like, there's no way that anybody can figure this out. I'm like, it's absolutely ridiculous. So it didn't take long after that to do the right thing. And that's what I've always tried to do. And so I came up with the idea, let's create a firm that's completely unbiased, completely transparent, completely educational in nature, and then have a way to utilize technology to feed all of the annuity products on the independent marketplace into one centralized location, and then be able to filter and sort, sift and compare, in a very efficient manner. And that's what we've done. So that's where we're at now, is utilizing a software to create an interactive and engaging experience to help people compare them, all of these annuities side by side in an unbiased manner. And it's amazing, and people love it. And we're really proud of what we're doing.
Yeah. And I don't mean to change it here and put the clouds over this a little bit, but it's also surprising, scary, concerning to see that so many other companies are out there. There's companies out there still functioning like that today. Whereas we've tried to create something different. It's just insane to believe that business can still happen like that with the technology that we have. So let's put a bow on it. The reasons why 99% of people make a mistake in buying an annuity, the 5 top reasons that we see: lack of knowledge, pressure from salespeople, misleading marketing, not working with an independent agent, and no efficient way to compare that annuity
To
product.
touch on the independent agent, you can still be working with an independent agent that still doesn't have access to every product. Just keep that in mind. Just because they're independent doesn't mean they've done their due diligence to have relationships with every company and carrier and provider of annuities. And that's what we've done. So we are a step above that, even on the independent side.
Yeah, and to carry over with that, it's also that specific individual, just making sure that they're aligned with your retirement goals. They're looking out, they're asking the questions. If somebody's not asking you the questions, that's where the concern comes in. If they're pitching a product and not asking you the questions that are important to you and what that retirement looks like for you 5 years from now or 15 years from now, there should be some concerns.
Without a doubt. Without a doubt. So that's going to get us to the last topic here, right, Zach? And we're going to do kind of a brief tutorial on how we kind of unveil the curtain, if you will, or discard the BS and all the marketing hype and fluff that you may be being pitched. And we want to make sure that we back up what we say. And the biggest thing here for us is transparency. And so one way we're going to do that right now is I'm going to share my screen, and we're going to go ahead and show you exactly how we would treat someone coming into our first meeting in that discovery and telling us that they've been pitched a product with a bonus, if you will, and showing them, how that bonus product isn't the actual best option for them. Most of the time, the bonus product is going to be inferior to a non-bonus product when it comes to just pure accumulation. So assuming that you're looking for a protected growth, fixed indexed annuity, and you're trying to just secure your money and grow it safely, there are these FIAs or fixed indexed annuities that have lofty sign-up bonuses or premium bonuses. And we want to show you that the bonuses are a bad deal. So let me go ahead and share my screen, and we'll get into that. So Zach created a snippet here of a couple scenarios, and I'm going to share that side by side.
Yeah, and to drive the point home, and what we're trying to practice here is, again, the transparency, and we're providing that transparency with data-driven analysis. So the software that we use, it's an innovative software that we utilize on a daily basis and allows us to do that comparison.
Absolutely. All right, so you created the snippets with the non-bonus version. Okay, so let me go ahead and share my screen here. I think we're ready.
Yep.
Let me know when you can see it, Zach.
Yeah.
We're good?
Got it. Yeah.
Okay. So let's see if I can do this right. So, okay. So what we're looking at here, this is a very popular product on the market for accumulation. And this is an example of just showing that this company in particular has a bonused version of this product, which is the Athene Performance Elite. And then they have a non-bonused version of the same product. And what I'm going to show you is how the bonus version of this product long term is potentially a bad deal. Now, of course, it does kind of predicate on how the index strategies perform over time. Right now, I have this filtered out to where it's only using the 1-year point to point strategies and the various index crediting options that are available. And the point is when you have a bonus product, so in this case, the Athene Performance Elite 10 has a 13% premium bonus at the time of this recording. So when you put your money in, let's say you put 100,000 in, 113,000 is credited to that account value day one because of the bonus. But what I want you to pay attention to is the actual participation rates on the underlying index crediting strategies that your money would be allocated to. And if we look at them, so for example, this 1-year NASDAQ fast convergence point to point with a participation rate, the participation rate is 87%. Now, if we pull up the same exact product, but the non-bonus version, the same exact crediting strategy is 122%. So that's almost 40% higher in the non-bonus version. So what does that mean? Well, in this exercise, we're actually using a hypothetical backtest. Again, we're not big on backtests. We're just using this as an example. We look at real data more than a backtest, but this is a good exercise to just show you that the bonus is a bad deal. These are the last 10, 15, and 20-year columns that represent the average annualized rate of return if you were to have used this annuity during that time frame with that specific index crediting strategy and being 100% allocated towards this NASDAQ fast convergence 1-year point to point. With the lower participation, that translates to a lower annualized average return over the 10-year window. The participation rate is very simple to understand. A lot of people get confused by it. All it means is of the actual index's performance for that 1 year in time, how much do you participate in? So if the index went up 10% in that 1 year, you would participate in 87% of that growth. Or in other words, you would receive 8.7% interest credited to your contract on that first anniversary. If we pull up the non-bonus version, we're now going to see how that higher participation, because there's no bonus on this product, so they're giving you more participation, how that translates to a higher average annualized return over the same exact 10-year period. So again, using the same 1-year point to point with the NASDAQ fast convergence, you're getting a higher growth potential long-term because of the higher participation. And we see this across every product. So you'll notice the next, crediting strategy, again, lesser return. This is substantial too. In the back test, this is what, a 3%, almost a 3% difference in annualized return. So
if you move that over to the left a little bit, then you can compare the
here
average 10-year return. There you go. And
Yeah,
it's equal across the board there.
Yeah, that's a great call out. So, it's a 3% average difference per year in the scenario. Again, this is a simulation. This is not guaranteed to ever happen, but it is something to show you the proof that bonus products are not a good deal. And just to clarify, the only time a bonus product can be utilized in the right way is if you're trying to get out of a bad annuity contract and there's a lofty surrender penalty and you want to offset that surrender penalty loss. A bonus product is really good at doing that. So if you had a surrender penalty of, 10%, if you use that bonus product with the 13% bonus, you're still net positive 3% after coming out of that bad contract. So in those cases, that's the only time we'll use a bonus annuity. Other than that, it's a bad deal.
Yeah, and we've seen that with maybe older contracts where at the time it was purchased, the market depicted a lower return from that index or lower caps, lower participation rates. So oftentimes we're seeing in the current market today that the current market is producing a much better return or much better potential return because of higher participation rates or higher caps. I think one key point that I wanted to mention on what you had just shown is not only do we consider that there was a bonus in the comparison and how much of a loss there was on the growth, but also comparing, and I think we'll see this on the one you're searching for now,
Yeah.
but a 7-year versus a 10-year. So oftentimes we'll see these bonuses appear on a 10-year option, meaning that that's a 10-year surrender period. Meanwhile, we're seeing a better performance on a shorter surrender period of 7 years as opposed to 10.
What am I doing wrong here?
What are you looking?
The 7. Yep. Okay, I got it. So, all right, here we go. So this is another carrier security benefit, another fairly popular growth-focused fixed indexed annuity, 14% bonus. Pretty big bonus. That sounds great, right, Zach? 14% on your money. I love it. It sounds awesome. And guess what? So does the annuity salesperson that's pitching it to you, because it's easy to talk about. And let's take a look side by side. So again, to show, I'm going to move it to the right here. This is the Strategic Growth 7 annuity that has no bonus. Look at the difference in the participation. 55% on the bonused version, 80% in the non-bonus version. How does that compare to the annualized back test? It's substantial. It's almost 3.5% here. 1142 versus 795. So again, bonus products are not a good deal.
Not only that, but again, the point that I just mentioned, here you are looking at a 7-year product, a shorter surrender window with a better return.
Yeah, so you have lesser time commitment, which is great, and you have more growth potential. And this is the product that they should be positioning to you if the strategic growth annuity is the right one. And the way we evaluate the equation there is, does it have good indexes? And so the way we do that is going into our real performance analyzer, the real data, the real-time performance. And that's what we really specialize in. So the question becomes, we have a grading philosophy. The growth annuity should have a minimum of 3, but preferably 4 or more proven, strong index crediting strategies. It should also have a lot of kind of diversification opportunity amongst those 3 or 4 index crediting strategies. You don't want them all to be correlated to the same asset class, because then they're all going to perform relatively similar, and you're going to have a 0 when that asset class has a bad year across the board. We want to try to diversify enough to where, hey, we had 2 strategies that were uncorrelated to the other 2. And in an odd year where 2 of the index strategies didn't do well, the other 2 did. And then you still get some sort of interest credited in that year. And one of the things I say is, we're ultimately trying to avoid a 0 in any crediting period. And why is that important? Because it's hard to compound 0. You can't compound 0. Simple as that. So, when we come to the table, we're going to show you the entire marketplace. If we're evaluating indexes, we're going to show you exactly what to look at and what to consider. These are all of the indexes available in these fixed indexed annuities. At the time of this recording, there's 164 of them. These are just the raw returns, the real returns, the raw returns, not including the participation. And we're going to evaluate them for you. And we reverse engineer it. We find the best indexes first based on real performance. And then we find the annuity that offers that index. Super simple.
Right.
Then we go through another step, and that is, okay, it has this index, but does it have any other ones that are available? Because again, we want to have a blend and an optionality of multiple indexes so that we can be agile as we move through the contract, since it's a long-term vehicle.
Right. And that's part of our ongoing relationship that we have, part of our annuity assurance process, and that we're going to continue that relationship with you, making sure that we're allocated to the right index options, making the right choices in the future. Not just, this is, again, I can't reiterate this is enough. This is not a one-time sale. This needs to be managed regularly. So there's no,
And
with the software that we use and the information that we provide, the education we provide, there's no education. It's not a sales tactic. You can see from what we've shown you, this is pure raw data.
it's real and it's no BS. And
Yep.
that's really what we're adamant about is, helping you ultimately avoid the mistake that 99% of annuity buyers make.
Yep.
And we do that by using the right tools, working in an unbiased environment, and helping you make smart, informed decisions backed by real data. And that all comes down to our core value, right, Zach?
Yeah. Yeah. When it's coming down to mainly is trust. And we're building that trust through transparency. So we're providing the information for you. Ask any question you want. We have nothing to hold back. We're providing all
Hey,
the information.
the other thing too, working with us is that maybe the advisor you're working with made a good recommendation, and you come to us and you tell us what they offered. We can help you back that up too and say, yeah, that was the right suggestion. That was the right recommendation. They did a good job.
Yep.
We're not going to win every deal when we don't expect to. What we do want to do is help you validate that you're making the right decision, whether that's with us or without it.
Yep.
So
Man,
with
I
that
think,
being said,
yeah,
anything
I think
else
that
that we
wraps it.
missed?
No, I think that was a great topic. I know we've had this come up before. So I thought it was really important that we present this and share it.
Yeah, me too, man. I'm really happy we got this one done. I think it was a very valuable episode that we covered a lot of real time facts about the wrongs of our industry, which we're passionate about changing. So if you're interested in working with us and helping you make a better annuity buying decision, you can do that by requesting your free annuity rates report. Right down here below this video in the description, there's going to be a unique link that you can follow to request that free report. And that is for us to start our relationship on the right foot. And that's with transparency. So you're going to be taken through a series of qualifying questions to understand what your objectives are for that annuity. And then we're going to custom curate a report tailored to your specific needs to show you the facts, to show you the rankings chronologically, highest to lowest of what annuities you should be considering to compare in order to make a really good decision. And that's really what we're passionate about. We love what we do. I think you can hear it come out in our voice. I'm all about helping people. That's just my calling, is to serve people. I also am a kind of a geek when it comes to data and numbers and economics and all of that stuff. So like I said before, when I found this industry as antiquated as it was when I first started and still is today, I knew that there was a huge problem that needed to be solved, and we're only getting started. Like, we're starting the retail side, we're solving that problem. I'm not going to share all of my ideas, but by the end of my lifetime, people are going to know who Annuity Association is and the advisors that represented us, because we're going to truly change generational lives because of helping people make better decisions.
Right.
And I'm super passionate about it. So appreciate everybody sharing the message and getting behind us with it.
Yeah. Love being a part of this journey with you. I love being able to share this information for anybody and everybody at no cost. And if you did find this episode valuable, um, subscribe, feel free to share it with a friend, anybody who may be considering an annuity, and make sure that you, your family members, and your friends don't fall victim to any of these annuity traps.
Absolutely. I love it. Way to close it out. So again, Jeremiah Konger and Zachary Van Es, the Annuity Dudes, signing off from the I Love Annuities podcast. Let's see if I can do the music. Here we go.
Let's go, DJ.
Yeah. All right. We appreciate you guys. Spread the word. See ya. All right.
No, that one was fire.